All right, welcome back, everybody. So, this is the beginning of our second set of video lectures looking at Chapter 7. Hope everybody is staying healthy and happy. So, in last chapter, we went over the budget, the static budget. So, our original master plan budget that we developed at the beginning of the year. And we saw how we developed that budget and how it can be used for planning purposes. And then we got into a little bit at the end about how it can be used to incentivize managers. So today we're going to take it a step further and look at something called the flex budget. And so we're really going to dive into variances that we'll get into a little bit more. Variances and how we can use variances and this flexible budget to get a lot of information in the future. So let's go ahead and dive in. So last class, we really focused on this planning aspect of the budget. We kind of quickly hit on all these other things, but today we're really going to focus on evaluating performance. And we'll see that there's a specific budget called the flex budget that's exceptionally useful at evaluating performance. So the basic concepts that we need to know before we dive in are variance. So we talked a little bit about this last week, or in the last lecture. And a variance is any difference between what actually happened, right? So we're at December 31st. We see the numbers, so this is year end. So we compare this to the budget. And the budget was, say we created it January 1st, beginning of the year. And so what we're interested in, a variance, is essentially 1, what actually happened, minus 2, what we had budgeted at the beginning of the year. So this difference is a variance. And variances can be favorable or unfavorable. So a favorable variance is exactly what it says, it's a good thing. And really the way you determine favorable is, hey, did it increase operating income? Were our actual results higher in operating income than the budgeted results, our budgeted amounts? So if that change increased net income, it's a favorable variance. Unfavorable is just the opposite. That if that change actually hurt net income, so this actual was lower than budget and it hurt net income, then that's an unfavorable variance. And we'll see that favorable and unfavorable, it's really important, but it can sometimes get confusing when you're looking at things like income and expenses. For instance, if an income item is higher than expected or per the budget, then it's favorable. But if an expense was higher or greater than the budgeted expense, that would be unfavorable. So just keep in mind, whenever you're looking through these variances and trying to decide if it was favorable or unfavorable, just walk it back and think, well, if that was higher or lower, what would that do to net income? And by focusing on the net income amount, you can really tell if it's favorable or unfavorable. So today, our main focus is going to be on this flex budget. And so last class, we looked at the static or master budget. And again, that's the budget we developed at the beginning of the year, January 1st. We developed that whole budget for the year. What a flex budget does is it looks at the performance at the end of the year and it flexes this master budget. It says, hey, had we budgeted for the correct amount of sales in units, what should have our budget looked like? So for instance, if your master budget said you were going to sell 100 units, well, that budget, the revenues, expenses, everything is based on 100 units, right? Because we learned that the sales budget or the amount of units you're going to sell influences everything. So if we plan for 100 units, but then we actually sold 200 units, well, it's hard to compare that static budget that was made for 100 units to the outcome of 200 units. So what we do is we say, okay, let's go ahead and flex our static budget. Let's flex it to assume that we had planned on 200 units. So we keep the ratios of expenses and revenue and all that we had for 100 units, but we flex those numbers by doubling them all to this 200 unit mark. And so it could be kind of confusing. That's up in the air still. So I think once we do a couple practice problems, it'll really help you understand when we say we're going to flex that budget. So let's dig in and let's see how this works. So let's start with just looking at the static budget and variances. So this is Oasis Pools. They're a company that builds and sells pools. And we see that they had a static budget that they created for the month of March. And then they have their actual results. Well, they budgeted for 8 pools. And based on 8 pools, they thought they'd have this $120,000 revenue, $95,000 in expenses, and an income of $25,000. Actually happened is they sold 10 pools, so that's a 2-unit favorable variance. They had $150,000 in revenues, so that's a good thing, right? It increased net income, so this is a $30,000 favorable variance, right? Because we're just subtracting these amounts. Expenses were $24,000 higher than planned. So that's an unfavorable variance. And income, it was $6,000 higher, so that is a favorable variance. So overall, our income statement would show a $6,000 favorable variance. So this is good overall when we're really just trying to look at this total income amount for favorable or unfavorable variance. But what's tricky is we can't really tell if our expenses, if this unfavorable variance here, if this $24,000 is good or bad, right? Because we're not really comparing apples to apples. Our static budget assumed that we were only going to sell 8 pools, but we sold 10, so we should expect expenses to increase. So the fact that we have an unfavorable there, we can't really determine, is that good or bad? Because we expected it to be higher than normal because we sold more pools. So this is where the flex budget will come in that we'll see in a second. It'll flex this static budget and see, hey, what should we have expected expenses to be had we sold 10 pools? So we'll get into that in a second. But for now, just focus on, hey, the difference between actual and static budget creates these variances. So this at the beginning is going to look a little daunting, but this is really the variance hierarchy that we're going to work our way through. And what this means is we start with, I'm going to go back a slide. We start with this overall variance of $6,000. So up here we say, okay, our static budget variance is $6,000. Let's see how much information we can get out of that. So we're going to want to disaggregate this or disentangle this variance and find out what caused that $6,000 variance. So let's start digging in and looking at that. So the first thing we want to do is we want to set up that flex budget that we were talking about. So per our budget, our pools sell for $15,000. The variable expense is $10,375, and our fixed expenses were $12,000. So if we flex our budget, right, because our static budget said we were going to sell 8 pools, but we're going to flex our budget to now assume we sold 10 pools. So we'd have our revenues, 10 pools, $15,000 per pool. We would expect our revenues to be about $150,000. Our variable expenses, 10 pools at $10,375 per pool would be about $103,000, $104,000. And our fixed expenses, right, those are fixed. So even when we flex our budget to account for more pools, Well, those fixed expenses should have stayed fixed at any given volume. So that's going to stay at 12,000. So this is what our budget would look like had we originally planned to sell 10 pools. So let's see how this compares. So we started with our static budget, and we know, like we commented before, that in this expense line item, in the static budget, we said we should have $83,000 expense. The actual results were $105,000. But knowing we sold more pools, we should have expected a higher amount of expense. So we didn't get a lot of information from that unfavorable variance. So in order to help us, we flex this static budget and create the flexible budget. And so now that tells us that what we should have expected based on our budget was this number here of $104,000. So you can see now if we compare that to actual results, okay, we did pretty good. We came in under, we didn't do as well as we should have because our expenses were $105,000, where per our budget, once we flex it to account for the 10 pools, should have been about $104,000. And so now we're really comparing the actual to flexible. We're comparing apples to apples. We can see how our budget really should have looked and our actual results. So the difference between the flexible budget and the static budget is our sales volume variance. And what you'll learn throughout this whole process is most of the titles of these variances are pretty self-explanatory. So sales volume variance means it's the variance that was caused by the change in sales volume. So when we flex our budget to account for 2 more units, well, that's the increase in sales volume. So all we did was flex our budget to account for the change in sales volume, and that resulted in about $9,200 more of income. So that's a favorable variance. So that's where we're going to start breaking down, remember, this variance, try to get as much information as we can. So now we can break that into one part of that variance is the sales volume. So we increased our net income by $6,000. So we had a $6,000 favorable variance. Well, of that $6,000, about $9,250 were due to the change in sales volume. So it could be a little confusing that due to sales volume, we had a $9,000 increase, but our overall static budget variance was only $6,000. So that's kind of a heads up that must mean that all the other things that weren't due to sales volume, this whole side of the hierarchy must have had an unfavorable variance to offset some of that favorable sales volume variance. So now let's get into that. First, let's get into a different way to calculate sales volume variance. If you don't want to go back and set up this table, another way you can calculate it is through this basic calculation here. So, like we said, sales volume variance, and this is another thing to keep in mind. When you see the word variance and you're trying to calculate something, what we do in the calculation is we vary whatever the title is. So sales volume variance, when we're calculating it, we're going to vary the sales volume. So we use our contribution margin per unit. That stays the same. And we multiply that by the difference in sales volume. So we're going to vary the sales volume, their actual units minus our units budgeted to be sold. So go back, look at our prior numbers. We see this is our contribution margin, right? Our revenues minus expenses, variable expenses, times our varied difference in actual and budgeted units. So we get our contribution margin times the difference in units equals our sales volume variance. And again, this is kind of quick, but hopefully with enough practice, this really starts to stick. So we've looked at the sales volume variance here. So now we're going to look at the flexible budget variance. And this is the difference between the flexible budget and the actual results. So here we look at the net income actual minus the net income flex budget. And it looks like our net income was about $3,000 lower than what we would have expected based on our flex budget. So therefore, we have about a $3,000 unfavorable variance. So now we've taken our $6,000 favorable static budget variance, and we've broken that down into a favorable variance due to an increase in sales volume, and an unfavorable variance due to other things. So our flex budget variance just says, hey, there's all these manufacturing expenses, and overall we had an unfavorable variance due to manufacturing expenses. So that's all we've done so far is we just started disentangling this or disaggregating this static budget variance into its two primary components. Sales volume variance, so the variance due to changes in sales volume, and the flexible budget variance, so the variance due to flexing the budget. And the flexible budget variance is really the variances from production costs and sales price. So know that at the highest level, the variance for the flex budget variance are all the variances from manufacturing costs and changes in sales price. And as you look down here, you'll see manufacturing cost, manufacturing cost, manufacturing cost, and sales price. And an important thing, like we said before, to keep in mind in this hierarchy is all these things add upwards. So the flexible budget variance plus the sales volume variance should equal the static budget variance. Just like, let's go, for example, way down here to the bottom, that the direct labor variance plus the direct labor efficiency variance should equal the overall direct labor variance. Sorry, this one over here is the labor price variance, and the labor efficiency variance equals the overall direct labor variance. So these should always add upwards. So keep that in mind. That's a very important principle to realize as we keep moving forward. So in this lecture, really we just learned the relationship between the static budget and the flexible budget and the two highest level of variances. And those two highest level of variances are the flexible budget variance and the sales volume variance. So we learned those two variances, and the most important thing we learned is what that flex budget is, that we want to be able to compare apples to apples, our actual results, to some budget that assumes we sold the correct amount of product. And by flexing our budget to show what would have happened had our budget been correct as far as the amount of products we were going to sell, allows us to compare apples to apples. So the next lecture, we'll continue moving down that variance tree or that variance hierarchy, and we'll break down the flexible budget variances into all those different manufacturing costs and the sales price. And we'll see that, man, we can really get a lot of good information out of that allows us to make better decisions going forward. So stick with us. We will see you in the next video, video 2 of Chapter 7.